Hi Ashwin, how are you doing?
I'm doing good, Manali.
Okay, so let's get right into it.
Sure, Manali. Let me just open the notes page so that I'm ready to take the notes that you're giving me. Please
Okay,
go ahead.
sure. Yeah, so your client is NextTable, which is in the restaurant software as a service business. And they're looking to acquire QuickServe, which is another software as a service platform, but that provides services to quick service or fast casual cafes. So, through this acquisition, they want to achieve a 12% revenue uplift in the first year after integration. So my question to you is, should they go for it?
Okay, thanks. Thanks for the problem statement. Let me recap what you've just told me so that I've not missed anything. All right. The client is NextTable. They are a SaaS platform provider catering to restaurants. They're planning to acquire QuickServe, which is also a restaurant-based SaaS platform, but they serve fast casual restaurants, right? The goal that they have is a 12% revenue growth in the first year, right? And the question is, should they acquire or not?
Correct.
Right?
Exactly.
Great. So from an objective perspective, the objective of the client is to achieve a 12% revenue growth in the first year, right? If they can do it, they would like to go ahead. If they don't, then they would not like to go ahead. Is that
Yeah.
clear? Okay. Okay, that's clear, right? Um, Now, what I would like to understand, Manali, a bit more is um, the product of these two companies, right? I mean, how similar and different are they, or different they are, right? In the sense that is it very similar features that NextTable and QuickServe offer, or is there a difference in their product?
Okay. Yeah, sure. So let me give you a little more information about that.
Yeah.
So, NextTable essentially serves full service and restaurants that are like casual or fine dining restaurants, and it caters to mid to large chains as well. And their core offerings include reservation and waitlist management, which is online booking, table assignments, and basic CRM like profiling of the customers and loyalty programs. And they also provide point of sale integrations, so the restaurant can track the data.
Okay.
Coming to QuickServe, they do not have any common customers with NextTable. So these guys offer labor scheduling and staff cost optimization along with inventory and waste analytics. So understanding how much the food costs and predictive ordering. So, they can do their inventory management easily, and also performance dashboards for any all the QSR restaurant operations. So basically, quick service more catering towards fast casual restaurants like cafes, small franchises, coffee shops, and they do mostly back end stuff. While NextTable does more of a front end kind of a service.
Okay, this is very helpful information. Let me recap, right, this information, right? Maybe synthesize it a bit more concisely, right? So, NextTable product, when I look at it, it's more of a front end, right, catering to
Mhm.
um, mid to large restaurants and full service dining, fine dining kind of restaurants, right? And it involves, reservation management, also CRM, point of sales, etc. Right?
Mhm.
And then we have QuickServe, right, which is more of a backend um, platform, right, which
Yeah.
offers labor scheduling, inventory analytics, performance management, and they're catering mainly to small to mid cafes, fast casual cafes, right, quick service cafes. Okay, that's very clear to me, right? Um, Now, if you can let me also know about the revenue model, right? Because both are SaaS platforms, right? I would imagine they might be, making money through subscriptions, but would love to understand how they are actually making money.
So yeah, so you're right. They do have an annual subscription and usage fee for the platform. So for NextTable, essentially they cater to around 25,000 active restaurant locations, and the fee for them annually is 4,800 per year.
Okay, got it. Got it.
Okay, and for QuickServe, they serve around 12,000 locations. They're smaller than NextTable, and they pay around 3,000 a year.
Okay, this is helpful. So if I have to calculate the revenue, so NextTable is serving 25,000 locations. The ticket size is around 4,800, right? So let's me calculate for 45 into 25, right? 15 to 25 is around is or 5 into 25 is 125. So this will be, I think, a little bit less. So maybe it's around yeah, if I do the precise math, it will be around 120 million, right? So this
Okay.
is a NextTable revenue. And QuickServe will be 12,000 and locations, 3,000 ticket price, which gives me 36 million, right? 12 into 3
Yeah.
is 36, right? So this is 120, this is 36. So total is 156. We're talking about a 12% revenue uplift, right? Right. 10% is 15.6, 1% is 1.5, right? So if I add up all that, it means roughly 20 million increment is what we're talking about, right? 19 to 20 million increment is what we're talking about,
Yes,
right? This is the goal,
exactly.
right? This is the goal of the client, right? First year, we need to have a revenue increment of approximately 90 to 20 million dollars,
Right.
right? Okay, this is quite helpful. So it's very clear to me now, the what the problem scope is. If you're okay, I would just lay out my problem solving approach, Manali, and I will outline my approach to you.
Sure.
Thank you. Okay, I am ready to present my approach to you, Manali. Right.
Sure.
The key question that we're trying to answer is, can the combined entity, right, NextTable plus QuickServe, get uh, approximately $20 million increment in the first year, right? In order for that to happen, right? So first we'll have to assess what is the additional value, right, that the combined entity can achieve, right? I'm not going into the standalone value right here because although in an acquisition, we need to look at standalone value, but the goal is very specific here, right? We've been asked to evaluate whether the combined entity can grow its revenue by 12% or not, right? So I'll get more specific in terms of the approach, right? So the additional value, in my view, will be the synergy value, right?
Mhm.
And the synergy can come from the revenue synergy, right? And from a revenue synergy perspective, I think there are a couple of ways, right, we can have revenue increment, right? One is the customer base expansion, right? Um, we can sell NextTable's product features to QuickServe customers and vice versa, right? So because of this cross platform selling, right, we will achieve certain revenue increase, right? Also, I think if we go to market as a combined platform, right? Yes, both of these might exist as separate modules, right? But when we go to market and tell restaurants that you will get both the features of NextTable and QuickServe, maybe at a slightly favorable price or a discounted price,
Mhm.
then I think you will see more revenue increase because of it, right? Also, I think because of working together, we might also have improved product features, right? For example, we could enhance NextTable's product features as well as QuickServe product features on a modular basis itself, right? Because we have more tech capabilities, right? The two SaaS platforms merging together means more engineering resources. We could look to uplift each or both products essentially,
Mm.
right, individually, right? So a customer base expansion, improved product offering, and combined go-to-market capability, right, is what will get us the revenue growth, right? And we need to assess whether this revenue growth will be $20 million or not, right? Then from a cost perspective, right, although there are some cost savings which we could realize, for example, um, when the two companies will combine, there could be some efficiencies in terms of product development, right? Efficiencies in terms of engineering, right, and tech maintenance, right? You could also look at sales and marketing optimization, right? As a combined entity, we'll have more buying power in terms of ads, right? We might need less sales staff, right?
Mhm.
There could also be support function consolidation, right? Optimizing, let's say, your HR, finance, and other resources, right? Um, However, because the goal is more precise, it's revenue growth, I'll not focus on cost, right? Maybe we can deprioritize the cost aspect and focus only on the revenue synergies,
Yes.
right?
So, yeah.
Um, right. And then what I want to do is that also want to look at the capabilities, right? Because in order to achieve these revenue synergies, right, customer base expansion, improvement in product, and the combined, go-to-market capability, right, we will need to have the technical expertise, right, or get access to the required technical expertise in order to manage this integration,
Mm.
right? Because if I want to sell to NextTable's customers QuickServe's product features, I would need to be able to have two modules that can operate together through, let's say, deep API connections where there is information sharing, right? So even if we don't pursue full integration, because it's unlikely we can go to market with a fully integrated product in the first year, right? But we can have two different modules, right, operating as an integrated platform, right, through API connections, right?
Mhm.
And also from a capability perspective, we'll also have to see, the client, does the client have the financial capability to not only to purchase, right, QuickServe, but also to integrate these two platforms, right? Because the integration cost could also be significant when you're talking about integrating two platforms, right, and going to market with a combined platform, right? And finally, risks assessment will also be key here, right? From a risk assessment perspective, what I'm thinking is the first thing that I'm thinking is the risks related to the software integration, right? It's possible that when we get into the weeds of it, right, we realize that actually operating these two platforms as independent modules and enabling deep API connections is quite challenging, and it will take much more time, right? And that will delay our synergy realization, right? And that could also lead to additional cost, right? I also see risk related to culture. We need to study how do these two companies operate, right? If they have very similar cultural DNA, maybe it might be easy to integrate. However, if one company operates in a very nimble manner, where there is more autonomy, while the other operates in a more traditional manner, there could be cultural clash, and therefore there could be risk of people attrition, right? Um, and finally, I'm thinking of customer retention also, right? Because as soon as we announce that there is this merger happening, right, some customers might get worried, right? They might think they will need to migrate to a integrated platform in future, or they might worry that they will need to pay more for this integrated platform, right? So I think that's something that we will need to closely assess, right? What is the retain customer attrition, or can we retain all the customers, right? Or will we see
Mhm.
customer attrition, right? Which will impact the revenues of the business, right? So these
Mm.
are my key areas of analysis that I've listed, Manali, right? If you're okay with it, maybe we can start with assessing, what is the scope of the revenue synergies, right? Based on
Mm.
customer base expansion, improved product offering, and the combined go-to-market capability.
Yeah. So I think, since the primary goal is a revenue uplift, I think, as you said, we should focus more on that.
Sure.
and let's look at the synergies that that we can gain by doing this acquisition. So here I have some information for you,
Sure.
if you'd like to note it down.
Yes.
Yeah. So, as you mentioned, there are three ways that we can realize the synergies. So the first would be to cross-sell QuickServe's module to NextTable's existing client base. So over here, we're looking at around 20% adoption among NextTable's 25K locations, and every location that adopts will essentially pay 1K per year in addition to what they're already paying. Okay.
Yeah.
Yeah. So the second one would be cross-selling NextTable's features to QuickServe's restaurants. So out of the 12,000 restaurants that QuickServe has, they'll have around a 15% adoption, and every location would pay them 2,000 per year in addition to what they're already paying. And finally, since it's an end-to-end integrated solution, there would also be new customers that would be coming in. So we're assuming around 2,000 new locations, and each of them would pay around what we have assumed is 3.5K per year.
Okay, got it, got it. So let me recap the information that you've given me, Manali, so that I've understood this correctly, right? First is we can cross-sell QuickServe product to NextTable customers, right? And here we're talking about 20% adoption, and each location paying $1,000 additional, right? And next is there is the NextTable product being cross-sold to QuickServe customers. Here we're talking about 15% adoption, and each location paying $2,000, right? And then there is this combined go-to-market capability that we have, that we sell both these modules, NextTable and QuickServe, right? And here we are selling it at a discounted price of 3.5K, and we expect 2,000 restaurants to sign up, right? So what I will do, Manali, now is I will calculate, right, what is the revenue opportunity for each of the three, right? So first I will calculate the adoption, right, percentage into the number of locations multiplied by the additional revenue that we expect, right? That'll fetch me what is the cross-selling revenue potential. And then for combined revenue potential, I will look at number of new restaurants that will sign up and how much they will be paying, right?
Okay, sure.
If that's okay with you, I'll do the math now, right?
Yeah, go ahead.
For the cross-selling of QuickServe product to NextTable's customers, we're talking about 20% adoption in 25,000 locations. That means 5,000 new locations will sign up, and each will give us $5,000 per year. So that means $5 million, right? And then if I go to this, there is 15% adoption. So this is 3,000 new locations. No, not 3,000, sorry. 1.2 is 10%, and half of that, so we're talking about 1.8 thousand locations, each paying 2,000, right? 1.8 into 2 is 3.6. So that should give me 3.6 million.
Right.
Right. And finally, when we look at the combined go-to-market capability, we're talking about 2,000 new locations, each paying $3,500. So that should give me 3.5 into 2 is 7. So it should give me $7 million, right? The total comes to 5 plus 3 is 8. This is 8.6 plus 7 will be 15.6, right? Now, $15.6 million is still short of the 19 to 20 million dollar increment target that we had that we have been given by the client, right? So 20, because we have been given by the client 12% revenue uplift, right? Which comes to around 19 to $20 million. And we are falling short of it,
Right.
right? Right. So based on this, right, we are not meeting the target, right? Um, However, when I look at this data, right, what seems interesting to me is the pricing strategy that we are adopting, right? We could look at a slightly more aggressive pricing here, right? For example, if I go back to my notes earlier, right, you had told me that currently NextTable's product is being sold at $4,800, if I'm not wrong,
Yes.
right? Yeah,
Yes.
$4,800. Yeah, and QuickServe product is being sold at $3,000, right?
Correct.
Which means that we giving the combined offering for just $3,500 would mean a discount of approximately 7,800 minus 3.5, right? That almost $4,300 discount, right? So it's a significant, a very steep discount we are offering for the combined product
Correct.
platform, right? So I think here there might be scope to increase the price, right? And we should check if let's say what will be the new restaurant signups, right? Because I think if we are able to market well, right, put more investment in marketing ads, also maybe improve the sales effectiveness, right? Train our sales force to communicate the benefits of the combined platform better. We should be able to still see high restaurant signups, right? Even if we increase this, right? Now, an increase in this price, as well as I think there could be increases in these two prices, right? Because we're talking about giving QuickServe product to NextTable customers for $1,000, right? Which currently sells in the market for $3,000, right?
Right.
So we're giving it for one third, right? So here we're giving it for half, right? Almost. Here we're giving it for one third, right? And NextTable product being given to QuickServe customers for $2,000, we are giving it for maybe even less than half, right? But around half,
Right. Yeah.
right? So I think there is scope to improve the pricing that we have here, right? And maybe promote more aggressively, improve the sales effectiveness, right? Educate and train the sales force in advance, right? To get the required revenue growth, right? So that would be my view, right? Although we're not meeting the 1 year target, right? My view is we need to check on tweaking the prices. Will we meet the growth in the first year, right? Also, the second thing is that maybe we should take a more longer term view, right? Rather than just taking a more shorter 1 year goal alone, right? In this particular context. Right?
Yeah. Yeah, so some very good points there, Ashwin. I do have an interesting segue for you.
Yeah.
So, you mentioned that there would be some risks when we try to combine the two platforms, to do an end-to-end integration with a single sign-on. So, I think the largest risk here would be customer churn, where, adopters of QuickServe would not really want to come under NextTable or like the bigger platform. They might worry about migration risks. So, can you devise some strategies to mitigate this customer churn?
Okay. So just to understand your question, Manali, what you're saying is that in future, um, the platform or the goal is to make the platform fully integrated, right? So I would imagine rather than having two modules where a customer might have both modules, but he has to sign up for each module separately, there will be one unified platform where this single sign up and I get access to all features, right?
Exactly.
That's what we're talking about. Okay, got it. And if that happens, we worry that there will be attrition of customers, right? Churn of customers, and the question is how do we mitigate it?
Right.
Right. Okay, that's clear to me. So the way I would approach this is that maybe I can take a couple of seconds, right, to really think through what could be ways to do this or mitigate this, and then come back to you with my approach.
Sure.
Sure. Okay, so let me share with you, in my view, what are the key mitigation steps that the client can take. All right. First, I think there are three main areas, right? One is communication, effective communication. Second is incentivizing restaurants. And third is ensuring a seamless transition, right?
Okay.
Let me elaborate on each of them, right? From a
Sure.
communication perspective, I think what you should be doing is that start being very transparent with the customers, restaurant customers, in terms of what is the integration timeline, right? What is the impact, right? Give them assurances that there will be minimal to no impact, right? Tell them that their favorite features, right, which they use every day will still be there. They will not be going away, right? There is no any, let's say, learning curve associated with using the full integrated platform. Also, we could use co-branding, right? Ensuring that, both the features will still be there in that integrated platform, right? So that's one about communication, right? Early, transparent, continuous communication, right? Second
Right.
is incentivization, right? Those customers, right, who have been with us, for example, let's say QuickServe customers, right, who are now paying $3,000 per year, right? And let's say we go with an integrated platform of certain higher value, right? Let's say 4K or maybe more, or as we stated earlier, like we were talking about $3,500, right? That would mean QuickServe customers would need to shell out more, right? So what we can do is we can tell them that for maybe next few years, we will give them a discount and they still need to pay 3K, right? So that we eliminate the concerns that QuickServe customers might have, right? And similar with NextTable customers, right? And what we can also do is that we can have some strategies, like we can have long-term lock-ins with these customers, right? For example, we can have conversations where we say you get the best of both these platforms, right? And if you take if you give us a 10-year subscription, you can lock in at what you're paying today, right? For example, if I go and tell QuickServe customer that, okay, you're paying $3,000 now for the next 10 years. If you buy a subscription and pay us now 3,000 into 10, right, you will get this platform for the next 10 years. There will not be any price increase, right? Annual price increase that you'll need to bear, right? So what that will do is that, we will get a defined, book of revenue, right? We don't need to, like SaaS platform, the challenges, there might be churn, we need to get new customers every year, right? So defined book of revenue will really help the client here, right? Minimize some of the risk of future revenues, right? And finally, I'm thinking of seamless transition, right? Here, what I'm thinking about is training, right? Training of the restaurant staff who use the integrated platform, right? So that they very seamlessly move from the current module to the integrated platform, right?
Mm-hmm.
We eliminate any disruptions, right? Through training their staff very well, right?
Mm-hmm.
And giving them a lot of resources, be it videos, be it FAQs, or be it even access to our staff, right? Our
Right.
technical staff in case of any issues, right? And also a dedicated customer support staff, right? So if they're facing any issues during the migration of the platform from the modular platform to the now new integrated platform, we have dedicated customer support staff, right, who can answer their queries as quickly as possible, right? So that will also give the confidence to the customers, and they will stay with us. So I think these are the
Right.
three
Got
main
it.
areas, right, that I would focus on as mitigation steps.
Okay. Yeah, that sounds good. So, given your analysis of the case, what would be your final recommendation to the client?
Okay, so let me also again take a few seconds to think through it, Manali,
Sure.
and we'll come back to you. Yeah, so I'm ready to present my recommendation to you, Manali. Right? In my
Sure,
view,
Ashwin.
I think we should go ahead with the acquisition, right? Although we are not meeting this 12% 1 year revenue target, right? But there are a lot of other factors, right, which are favorable to this acquisition decision, right? One, when we looked at the price assumptions that we have taken, right, to come to how much more revenue we can get, right? How many more from a synergy basis, right?
Mm.
The pricing assumptions seem very conservative, right? For example, we are charging for the combined offering $3,500, while today in the market, combined offering is around $7,800, right? So it's less than half, right? So there is scope to improve pricing, right?
Right.
While cross-selling, right, each product to the next customer base, but also for the combined offering, right? And if we
Right.
make the necessary changes to the pricing, I believe we will be meeting the 12% first year revenue growth target, right?
Mm-hmm.
And second, I think we should take a more longer term view, right? 1 year is too short a time to evaluate whether the acquisition makes sense or not, right? Maybe a longer 3 to 5 horizon will be a better time frame to consider, right? And third, I think what we are not looking at, and that's something that we need to maybe deep dive further and investigate, is the client is getting access to a new customer base, right? Customer segment, which is fast casual customer segment, right? And if this customer segment is going to grow in future,
Mm-hmm.
right, then it might be a good customer segment for us to enter early, right, through
Right.
this acquisition, right? Um, However, having said that, I think there are other areas that we need to analyze. One is the capability of the of NextTable in terms of integrating the two platforms, integrating the people, right? Which will entail significant cost, right? So does the client have the financing to acquire the company as well as finance the integration cost? Right. And the
Mm-hmm.
risks, right? I see significant risk related to software integration, right? Because if we intend to, let's say, go to market as two modular platforms, but together, right, that will involve deep API connections, right?
Mm-hmm.
Can the client actually implement this? Right, that's a capability issue. And if it's possible that we discover later that this will take more time, right, which will put our 1 year synergy realization at risk, or it will cost them more, right, which will
Mm-hmm.
impact the integration cost, right?
Right.
That's software integration risk is a key risk that I would like to deep dive further and evaluate, right? And in future, right, if you plan to become a one platform, one unified platform that we can go to market with, right? Again, there might be risks to that, right? Which need to be carefully evaluated, right? Risks related to customer churn, right? Specifically, risk related to how unwieldy the platform becomes, and therefore product adoption, therefore product sales might suffer, right? So these are
Mhm.
some of the risks that I would like to highlight, right, that we need to deep dive into before making a decision.
Right. Okay. I think that pretty much covers it all. Ashwin, thank you so much for your time. I think
Thank you.
we're good to go.
Thanks a lot, Manali. Lovely talking to you.
You too.